Thank you for joining Alpha Kappa Alpha Sorority Incorporated, Upsilon Epsilon Omega Chapter for the What's the 411? Taxes for 2021. This evening, UEO will be joined by Patricia Veney, CPA from the Veney Financial Group. But first, a word from UEO's chapter president, Kendra Brown.
Hello, my name is Kendra Brown, and I serve as the president of the Upsilon Epsilon Omega chapter of Alpha Kappa Alpha Sorority Incorporated. I welcome you to tonight's conversation, What's the 411 Taxes for 2021? We welcome Patricia Veney, who is a CPA from the Veney Financial Group. This is going to be a wonderful conversation. It is that time, it's tax time. Building on target 3 of building your economic legacy under the Exemplifying Excellence through Sustainable Service International Program that we are operating under. I know that this conversation is timely, it is relevant, and it is needed. So we welcome all of our attendees. Thank you to Lauren Jones, who is our Target 3 lead, for her leadership and ensuring that we have timely information for our community. And also Nakia Showell, who is our vice president of our chapter, who leads our program efforts. Again, tune in. This is a great conversation. Take notes, ask questions. We thank you for joining us today.
Thank you, Ms. Brown, for the welcome. My name is Lauren Jones, and I serve as lead for the Target 3, Building Your Economic Legacy. A part of this focus within this target area is on financial education and empowerment. We focus on savings, improving your credit, growing your finances, and so much more. Today, we have the pleasure of talking with a local certified public accountant, focusing on something that we all have to deal with this time of the year, and that is taxes. We are honored to have with us Ms. Patricia Veney, the owner of Veney Financial Group, a Black woman-owned full-service financial firm that has been in business for over 13 years. Ms. Veney says that her company takes a very different approach and philosophy in working with their clients from the traditional accounting and financial services. They provide a 3-tier approach to services, including tax preparation, business advisement, and investment and financial planning. We are pleased to have Ms. Veney with us this evening, and it's my pleasure to introduce you to her. Ms. Veney, thank you for joining us this evening. This is a topic that is very pertinent for this time of the year, and I know that you have quite a bit of information to cover, so we're going to dive right into it to ensure you have as much time as possible to cover this very important topic. Ms. Veney?
Thank you, Lauren, and thank you, ladies of Alpha Kappa Alpha, for inviting me and just allowing me to come in and share some important information with you all. This year has come with quite a bit of changes and in some cases, challenges. And so I'm going to just spend this time with you and just go through some of the old laws, go through some of the new laws. And most importantly, I'd like to take a little bit of time just to give you some tips on, how to minimize some of the issues that could potentially come up when you're dealing with the IRS. So I don't have time to speak on every law, but what I've done is I've picked the areas that I think would be most valuable to you during the time that I have. So one of the biggest challenges that I am seeing right now is the backlog with the IRS. And so the IRS has, when I tell you millions, they have millions of returns from last year and prior years that have not been processed at all. And so I don't know what that's going to look like when this all pans out. At this point, the end date for the IRS is April 15th. And so what I'm going to say to you, my friends, is if down the road you hear that they've changed this date to May or June 15th, just know that Trisha's sitting home with an attitude, because what I don't want them to do is extend this tax year by any stretch of the imagination. So just pray for a sister if you guys hear that. So let me just start by making 2 points. The first point is if at all possible, never ever mail your return. And I'm going to give you two reasons why. The first reason is when you mail in your return, that means someone has to physically take that return and key it into the IRS system. So what's the problem with that? The first problem is it can cause data entry errors that could create issues for you down the line. The second thing is it means that somebody's really looking at your tax return a little closer because now they have to enter the data. That's not to say that you've done anything wrong, but the last thing you want is for them to look for anything, right? So if at all possible, just try to file your returns electronically. And then the second thing I will say is if your return is complicated, if you are unsure about the laws, please, please don't try to do the return on your own. What I have seen is it will cost you much, much more in the long run, and it's just not worth it. Now, if you have a simple return and you feel good, go for it by all means, but just seek professional help if you have a difficult return. So let's just dig in and start by looking at some of the updated charts for this year. The first chart is the tax rate chart. So clients ask me all the time, well, what tax bracket am I in? This just gives you an idea, and I just want you to see. So I'll use a single person who made $86,375 up to this 164. That person's in the 22% tax bracket. So that just gives you a range of about how much a person would be paying in taxes after all of the deductions, what bracket that they would be in. So just to give you an idea of what that looks like. So the second chart is the long-term capital gains rates chart. And the interesting thing about this is for long-term capital gains, if your income is at a certain level, you don't even have to pay long-term capital gains, right? So let's just use single again. And let's assume that your income is $40,400. If you fall into that range, you don't have to pay any capital gains tax, which is huge because that did not used to be the case. And so this is for long-term capital gains. So short-term capital gains are taxed at an ordinary rate. So the difference between the two is just how long you hold the assets. So long-term capital gains is if you hold the asset more than a year, and short-term, of course, is anything held less than a year. So the last chart I want to just share with you is the standard deductions. So this was a big change for taxpayers over the last few years, because what the IRS has basically done is giving you a larger opportunity to decrease taxable income by using this standard deduction. So let me back up just a second to explain to you the difference between the standard deduction and itemized deductions. So itemized deductions are generally used when someone owns a home and they have mortgage interest and they have real estate taxes and charitable contributions. And so you add up all of those deductions and you take that amount and you just decrease your gross income by that amount. But what the IRS has done is they've increased the standard deduction so much so that most people, their itemized deductions are lower than this standard deduction. So what do? We're going to use the one that benefits you the most. And in a lot of cases, it's just been this standard deduction. So as an example, if you are, let's use head of household this time. So if you are head of household and your itemized deductions are less than $18,800, then we're going to use the standard deduction, because what that's going to do is it's going to decrease your taxable income and ultimately decrease your tax liability. And that's kind of the name of this whole game. How much can we decrease tax liability? And so that's kind of the focus that we're always looking for when we're preparing the tax returns. So let's talk about what's new. One of the items on the tax return this year is a line item called income not associated with the business. So let's start right here. So I often hear clients who come to me and they say, well, I started this business so I can take a loss and decrease my taxable income. So what's wrong with that? What's wrong with that statement? First of all, if you're going into business just to decrease taxable income, you're going into business for the wrong reason, right? So I tell my clients all the time, if you're paying taxes, you're making money. That's the goal. The other goal is to strategize to minimize how much you're giving Uncle Sam, not to continuously show a loss. And so if you're continuously showing the loss, the IRS is going to wonder if this is a hobby or if this is a business. So now the IRS has added this line to show hobby income. So what this tells me is something very important. It's telling me that they're now looking at taxpayers who are continuously showing losses, business losses on their tax return. So that's something I need you to pay attention to and look out for as well. The other issue with this is, first of all, I don't know about you, but who's going to just say, hey, I sold baseball cards last year and I made $100. It was a hobby and I'm going to claim it on my taxes. Now, I'm a tax professional and I'm not telling you not to show income. I'm just saying when the IRS did this, I don't know who they expect to actually report this information, but we'll see what happens. Now, let me end this slide by saying, if in fact you have a legitimate business, and let's say it took longer to get it off the ground than you anticipated. It took, 3 years or 4 years. And so you had to keep socking in money to get it where you needed it to be. If it's a legitimate business and it's legitimate losses, by all means, show it because you're entitled to do so. So there's just a difference between how you're showing it and what you're showing it for. As an example, if I have a client who's been selling jewelry for the last 5 years and has never made a profit. She enjoys it, but then you have to question, is it a business or is this just something that you enjoy and it's a hobby? So just keep track of that. The next thing I want to touch on is this advanced premium tax credit. So this is a big one. So let's just dissect this one for a minute. Oh, I lost my mouse. So, sorry guys. So let me start by saying the last year or the years before, the child tax credit was literally just $3,000 for any child under the age of 17. That's what it was, pretty cut and dry. But now what has happened in this new world is they've included a child who is 17. So before, that 17-year-old would just fall through the cracks. They wouldn't get any credit for the child if they were 17, and then 18 when the child went to college, they got education credit. Now they've included this 17-year-old as a part of the child tax credit, which I thought is a really great idea because it was just like that 17-year-old fell through the cracks. The other thing about this new law is it's giving a taxpayer $3,000 per child between the ages of 6 and 17, as long as they were that age by the end of 2021, and then $3,600 per child under age 6 at the end of 2021. So this credit phased out for any income over $150,000 for married filing joint, $112,500 for a head of household, and $75,000 for everyone else. Now here's the interesting part. For people that qualify for this credit, they got 50% of the credit in advance between July and December, and then the other 50% was claimed at tax time. So the credit that the IRS is giving you was based on 2020 returns, because of course 2021 wasn't filed. If by chance you had not filed your 2020 return, then the IRS would look back to 2019. Now, the interesting part is this advanced child tax credit is only for 2021. It's not something that's going to continue to go on. And what's also important is the IRS is supposed to send out taxpayers who receive this advance credit. They're supposed to get a letter from the IRS, letter number 6419, so that you can give that letter to your preparer or use it while you're preparing your return so that you report the exact amount that was sent to you in advance. So what is the problem with this advance tax credit? If your income changed or anything changed that no longer qualifies you for this credit, you may have to pay this money back. And I say may because the IRS has created a safe harbor amount where the taxpayer wouldn't be required to pay the child tax credit back if they fall under certain thresholds. So let's just take a look at those thresholds. So if you are, let's stick with head of household this time. If you're head of household and your income is $50,000 or less, then any child tax credit that you received, whether you qualify for it or not, you fall into the threshold and you don't have to pay it back. As your income creeps towards 100,000, then there are percentages of that child tax credit that you are going to have to pay back. If your income reaches 100,000 or more, then you have to pay it all back. So in some cases, this child tax credit was an awesome thing for a lot of people who had children. But in some cases where a taxpayer splits the child and, one year they claim this child and then the father claims the child the following year, in those cases, you could have some potential problems. So just be on the lookout for that because I can see that being an issue for this tax season. So let's talk a little bit about what's changed. So under the American Rescue Plan, the federal government last year excluded up to $10,200 of unemployment for taxpayers who made less than $150,000. Unfortunately, this exclusion for the federal has not been extended into the 2021 tax year. So 100% of your unemployment will be taxed for what you received in 2021. So I hope that most people have had federal taxes withheld to offset this unemployment compensation because they did not extend that exclusion. Something else that's changed is the charitable contribution deduction for non-itemizers. So remember a few slides back, we talked about standard deduction versus itemized deductions and how a lot of people now aren't able to itemize. So last year, the IRS said, hey, if you can't itemize, we're still going to give you $300 of charitable contributions if you paid up to $300 in cash contributions, regardless of your tax status. The new rule says that for married filing joint taxpayers, they can now deduct $600 from their taxable income for 2021. Now, one of the things I will say is that it has to be cash contributions. It can't be a contribution to Goodwill or Purple Heart or anything like that. It just needs to be a cash contribution. And this was a deduction that a lot of people forgot to add in last year if they actually had cash contributions and couldn't itemize. A lot of people just left that off. So that's one of the things I'd like for you to just keep track of. So the next thing is, what is a premium tax credit? Because this particular item within the tax law has caused taxpayers an awful lot of headache. So basically, a premium tax credit is a credit that's available for taxpayers who are enrolled in the health exchange and who are not eligible for other qualifying coverage or affordable employer-sponsored health insurance plans. The change is that now more people qualify for this credit because they increase the income eligibility. And the tax credit is based on income when you apply for the insurance. So if your income changed or you did not report the correct income when you went to the health exchange to get insurance, you would have to pay back this premium tax credit. And I have seen situations where a person said, you know, they went down and applied for this insurance, and they may have told the representative that their income was $50,000 as an example, because I don't think that the representatives asked for proof. But when we went to do the tax return and his income was $90,000, he had to pay all of that premium tax credit back. So I would just say be very, very careful if you're applying for health insurance through the exchange and you're getting, you know, a tax credit on that, that you make sure that you report the correct amount. Or if your income changes, you need to go back and make sure that you report that so that you don't have any issues in the long run. So this is basically what I said, that you have to pay it back. One of the things is last year, it was kind of a gimme, right? So the IRS took this premium tax credit piece away, where if you didn't pay enough or you didn't report the right amount, that you did not have to pay back anything. And so this year they've taken that away, and you do have to repay excess advance premium. Now, if your income went down and you paid too much, then you get a credit. So it's kind of a good thing, but just make sure that you report the right amount of income if you go to the health exchange for insurance. So let's move into the child and dependent care credit. One interesting thing that they changed is this used to be a credit that decreases your tax, but now they've made it a fully refundable credit where it actually adds to your refund amount. So this is a pretty decent change for taxpayers who are paying child and dependent care, because Lord knows it's expensive and they should give a bigger break for this. And so I think that they realized that, because they've even increased the limits for the expenses. So they've increased it from $3,000 to $8,000 for one child and $6,000 to $16,000 for two or more children. So that's a pretty big jump. They've also increased the percentage of the credit. So it used to be 35% of that $3,000. Now it's 50% of the newer threshold. So that's going to be a pretty nice change for parents who are kicking out a lot of money for childcare. The maximum amount of this credit is $4,000 for one child and $8,000 for more than one child. So definitely take advantage of that if you're paying money out of pocket. Now, of course, there's thresholds with everything. And the threshold for the child and dependent care credit is if your AGI is more than $125,000, then the credit is reduced by 1% for every $2,000 over that $125,000. So, you know, when you get, you know, income is super high, then you don't get the credit, but hopefully some of you will get to take advantage of this. The next credit is the earned income credit. And so this is a credit for low and moderate income taxpayers. They changed the qualifying age, because you used to have to be 25 to qualify for earned income credit, but now you can qualify for earned income credit if you are 19. So let's take a look at this chart just to give you some backdrop. Hopefully you guys can see this. The maximum amount of income you can earn and still get this credit has increased. And so I'm not going to go through the whole chart, but I'm just going to show you how this is working. So let's say you have two children, not 10. Oh my goodness. Let's say you have two children and your income is up to $53,865. So the income range where you can get the maximum credit is $5,980. But if you look up here, you can also get earned income credit if you don't have any children, right? So if you have no children and your income is up to $27,380, you can get up to $1,500 in earned income credit. So this middle section right here just basically says that in order for you to get the maximum credit, your income needs to be between $9,820 and $17,560. So let's look into this earned income credit just a little bit further. So one of the interesting things is for tax year 20 and 2021, if your earned income takes you beyond that threshold that I just showed you, then you can go back to 2019 and use 2019's income. I'm super surprised that the IRS is allowing taxpayers to do that, but I definitely would take advantage of it if you fit into that category. The other thing is, in order to get earned income credit, you must meet 3 tests: age, relationship, and residency. So let's look at that real quick. So age, you have to be under 19 at the end of 2021, or under age 24 and a student at the end of 2021, or permanently and totally disabled at any time during 2021, regardless of age. So let's talk a little bit about relationship. So I'm not going to read all of these, but basically it has to be your son, daughter, stepchild. It can be your brother, sister, half brother, half sister, and it also can be a foster child. But it has to be a foster child that was placed by an agency. It can't be someone that you've just taken in to help a family member or something like that. It has to be a foster child that's placed by an agency in order for you to get this earned income credit. And then residency just basically says that the dependent lived with you for more than half of the year.
Our presenter, Patricia Veney, is representing the Veney Financial Group, which is located at 300 Redbrook Boulevard in Owings Mills, Maryland. They can be contacted through phone at 410-597-8009 or emailed at info@veneyfingrp.com. For more information, please visit www.veneyfinancialgroup.com. And now, back to our program.
So there are 2 education credits. One is the American Opportunity Credit, and the other one is the Lifetime Learning Credit. The one thing that has changed is it used to be income thresholds, separate or different income thresholds for both of those education credits. And so what the IRS has done for once is simplified things and made the thresholds for both of those credits the same. So let's look at the differences between the 2. So the American Opportunity Credit is basically for college expenses, specifically for a 4-year college for an undergraduate degree. And the maximum credit for the American Opportunity is $2,500. Now, the Lifetime Learning Credit, which is a little different, gives you a little bit more qualifications. You can use it for graduate school, undergraduate school, vocational courses. There's no limit on how many years it can be claimed. Some of us have students that take a little longer than 4 years to finish their degrees. So you can just switch over and get the Lifetime Learning Credit. The biggest difference is that the maximum credit for lifetime learning is $2,000, not the $2,500. So it's available to taxpayers with just a gross income of $80,000 or less, or $160,000 if you're married filing joint. The credit is phased out if the taxpayer's adjusted gross income is between 80 and 90, and it's phased out if the taxpayer's adjusted gross income is between 160 and 180 if married filing joint. And if you're over the 90,000 and over the 180 for married filing joint, then you get no credit at all for those. So let's talk a little bit about what stayed the same. One of the things that stayed the same is if you are 72, you have to take required minimum distributions from your IRAs. It's not an option. It's IRS's way of saying, you've held on to this money long enough and I want a little bit of it. So there's a required minimum amount that you have to take out. So I wanted to bring this particular slide on because last year you did not have to take this. So during the pandemic, they gave taxpayers the opportunity to say, hey, I don't need it, I don't want to take it, and so there's no penalty. But now they have re-put this back in place, if you will. And if you don't take it, the penalties are pretty high. So just pay attention to that and make sure that you're taking required minimum distributions out of your IRAs. Another thing that stayed the same was the student loan interest deduction. And this is a pretty nice deduction. You may deduct the lesser of $2,500 or the amount of interest that you actually paid, whichever is less. You can claim the deduction if the following applied. And I'm so sorry, this is really small, but I'll read it to you. You paid interest on a qualified student loan in tax year 2021. You're legally obligated to pay interest on this qualified student loan, and your filing status is not married filing separate, and your adjusted gross income is less than whatever the threshold amount is because it's set annually. So I don't want to give you specific thresholds on that because they do change. And then the last piece of that is neither you nor your spouse, if filing jointly, can be claimed as a dependent on someone else's return. So if you meet all of those qualifications, then you definitely can take the, I think it's one more. And if you're single or head of household or qualifying widower, your interest deduction is phased out at $70,000 and completely phased out at $85,000. And if you're married, your phase out begins at $140,000 and completely phases out at $170,000. Okay, let's talk about the retirement plan distributions that were taken in 2020. So, if you take out retirement plan distributions pre-59 and a half, you have to pay a 10% penalty. So for 2020, that was waived. You didn't have to do that. The loan amount that you could take was up to $100,000 out of your IRAs or 401ks, 403Bs, or whatever your retirement vehicle was. And as I just stated before, there was no RMD required in 2020, and that was just in 2020. Now, one of the biggest pieces of this puzzle is the distributions that taxpayers took out in 2020. They were able to spread that distribution out over 3 years. So let's say you took out $90,000. First of all, the 10% was waived, but the other side of that coin was you could spread that $90,000 income distribution over 3 years. So you would take $30,000 in 2020, $30,000 in 2021, and you would take the final $30,000 in 2022. So here's the issue I see with this. For those of you that spread that distribution out over 3 years, you probably made out fairly well in the 2020 year, because what happened was you took out $90,000 and you probably took out enough taxes to offset that $90,000. But what's going to happen now is over the next 2 years, when you have to show the other 30 and the last 30, there's no taxes that have been taken out for those other 2 amounts, right? Unless you paid estimated taxes or you did something to offset that. So I think a lot of taxpayers who, took the benefit of spreading that out over the last 3 years, over the next 3 years, is going to probably have some issues over the next 2 years because of that additional income that's going to show up on your tax return that hasn't been, where there are no taxes being withheld. So what can you do about that? So there really isn't a whole lot that you can do for 2021 tax year because that year is over. But for 2022, you have a few options. The IRS is actually allowing you to pay the money back. That's a great option if you can do that. So let's say you can do that. If you can pay that money back, then we would have to go back and amend the last year's return to say, hey, I'm paying it back, so don't tax it. But I would venture to say most people can't pay back $90,000 unless they had some type of plan in place. And so the other option is to start paying estimated payments towards that other 30. I'm still using that $90,000 example. Or what you can do is have your taxpayer determine how much that $30,000 is going to affect your return. And let's say it's going to affect your return by $1,200. It's going to cause you to owe an extra $1,200. Well, have $100 per month come out of your regular job, your W-2 job, to offset the distribution that's going to show up in 2022. So just something to strategize so that you don't have an issue when you do next year's taxes. And, if you haven't prepared this year's taxes, then maybe this is an opportunity for you to just put some of the money aside. So knowing that it could potentially cause you a problem. So just be on the lookout for that. One of the other things that I wanted to touch on was that third stimulus. So the third stimulus, which most people received in January of 2021, and it was $1,400 per person. Some people, for the other two stimuluses that we received, that we reported in the 2020 year, reported the wrong amount. For some odd reason, people couldn't find the amounts in their bank accounts. They couldn't remember how much they received. And one of the things I will say is that if that is the case, and you reported the wrong amount, and let's say the IRS gave you a refund because you said, hey, I never received it, and then they gave you that money in the tax return, and then they come back and say, hey, actually, we did give that to you, you're going to have to pay that money back. In addition to the fact that if you don't report the right amount, your return is going to get hooked up in all of those returns that didn't get processed. Because now the IRS has to go and do a reconciliation because you said you only received $1,000 and they should have sent you $1,400. So just be very, very clear and very, very sure when you are reporting that third stimulus. Now, with that being said, there should be another letter coming from the IRS. And actually, a few people have received that letter. So I'm going to give the IRS a little bit of credit. There is a letter, Form 6475, that says how much of that $1,400 stimulus you actually received in 2021. So just make sure that you report that correctly on your tax return. So another point of interest, and this is very interesting and very new. What you see on your screen is what's called a 1099-K. So what's a 1099-K? It's a document that is given to individuals or organizations that have a business and they use credit to accept payment for the goods or the services. So if you accepted any amounts totaling more than $600, then the merchant that you use, such as Square or Stripe, will send you this document, this 1099-K. Now, starting in 2022, for the tax return that we'll prepare in 2023, this 1099-K will now include money you receive from PayPal, from Venmo, and from Cash App. So not only will you receive this 1099-K from the merchants, the IRS will also receive that same 1099-K. So it's not something that you can necessarily ignore because now the IRS knows that there's been a transfer of money. Now, it doesn't necessarily have to be a big deal. If you're anything like me, I Cash App my kids money all the time, right? So that could potentially be an issue for me as a business owner. But what I really need to do is, as business owners, if any of you have businesses where you use merchant accounts, just use a different form of payment for your kids than you do for your business. Now, with that being said, Venmo and Square and Stripe should have something in place now that allows you to check off whether it is personal or whether it's business. Now, let's say you didn't see that, or you haven't seen that when you've transferred money to a family member. If that is the case, you just have to keep a reconciliation of if it was business or if it was personal. So personal being sending money to your kids or to a relative. And so let's say your 1099K shows $20,000 and 5,000 of that money went to a relative. Then you're just going to create a reconciliation just in case the IRS comes back and ask, where the other money is showing up, because 15,000 of it is going to show on your return as part of your business income. And so the IRS has something that says that you technically received or sent out 20,000. So just pay attention to that, because that's going to be a big piece next year, especially for business owners that use credit cards for their business and use credit cards for personal. So the last piece of this puzzle, and I'm just going to touch on these briefly, I'm not going to go into big detail, is credits and deductions specific to Maryland. I'm assuming that the majority of my viewers on tonight are residents of Maryland. So I'm just going to touch on a couple of credits and deductions that are available for Maryland. So this one is a new one. This is a new credit. It's called a Quality Teacher Incentive Credit, and it's for qualified teachers who pay tuition to take graduate level courses. So this is a brand new credit. I think it's awesome, especially all of the scrutiny and all of the issues that the teachers have seen over the last couple of years. So I think this was a really good one that Maryland is adding in. Long-term care insurance credit. So basically, if you have long-term care and you're paying premiums, then you can take a credit on the return. Actually, you can take this credit federal and state. However, if the credit on the federal side is an itemized deduction, and if you can't itemize, then you wouldn't be able to take it, but you would be able to take it on the Maryland side. Independent living tax credit, and this is for anything that you installed for accessibility features either in your home or outside of your home. So this is a credit that Maryland is giving you as well. Endowments of Maryland historically Black colleges and universities. And this is if you make donations to qualified permanent funds held at the qualified, historically Black colleges. So let's quickly go over the deduction. So here is another new one where you can deduct up to $5,000 per year of an amount that you've contributed to a designated first-time home buyer's savings account. So this is pretty good for our younger viewers who are thinking about buying a house in the next few years and they are saving anyway. At least get a deduction for it. I think it's a great thing. Unemployment compensation. So this year it looks like Maryland is still not taxing unemployment. So it's taxed on the federal side, not taxed on the state side. Pension exclusion. So if you receive pension, you can exclude up to $32,300. So they increased that this year. Social Security, of course, is excluded on the Maryland side. Up to $15,000 of military pay is excluded from your income on the state side, and up to $5,000 of retirement pay for military taxpayers is excluded as well. Wow, I said a whole lot in a little bit of time. I would really, really, really like to thank everyone for joining in and just listening to the little bit of information that I had to share with you. Just want to share with you who we are and what we do. I am Trish Veney, the CEO and founder of Veney Financial Group, and we specialize in income tax planning, preparation for individuals and business, retirement planning. I am also a financial advisor, and we also do small business consulting and coaching. So for additional information, or if you wanted to use our services, You can reach us at 410-597-8009 or email us at info@VeneyFinGRP.com. Again, I would love to thank the ladies of Alpha Kappa Alpha for allowing me this opportunity, and I hopefully will see some of you soon. Take care.
Ms. Veney, we thank you for the wealth of information that you have provided our audience with this evening. As we bring this program to a close, we thank you again for helping UEO to provide information on taxes for our community. Thank you. Ladies and gentlemen, I encourage you to reach out to Ms. Patricia Veney and her company, the Veney Financial Group, for your tax needs. Now, before we close out our program, please remember that after our closing, there will be a survey link provided. We ask that each of you take a minute to just complete this survey so that we may continue to bring you informative programs like this one tonight. Now, to close out our program this evening, the Vice President of UEO, Dr. Nakia Showell. Dr. Showell?
Thank you, Ms. Jones. Good evening, everyone. My name is Dr. Nakia Showell, Vice President and Program Chairman of the Alpha Kappa Alpha Sorority Incorporated Upsilon Epsilon Omega Chapter. We want to thank all of you for joining us this evening for our What's the 411 Taxes in 2021 event. We would love to get your feedback about this event, so please complete the survey when you have a moment. On behalf of the Upsilon Epsilon Omega Chapter, we want to thank our guests of the evening, Ms. Patricia Veney, owner of Veney Financial Group. Thank you for sharing this extremely helpful and relevant information about preparing 2021 taxes. This was such an informative discussion, and I know I learned a lot. We are so honored to feature a business leader with such knowledge and expertise. Thank you, thank you, thank you. We also want to thank our lead for today's event and of our Building Your Economic Legacy Program initiative, Ms. Lauren Jones. Please join us for our upcoming events. February is Heart Health Month. On February 23rd through the 27th, UEO, along with the Tau Theta undergraduate chapter at Stevenson University, will be hosting our second annual virtual Walk Run 5K. Be sure to check out our flyer and social media websites for more information on how to register for our Walk It and Go Red, and donate to the American Heart Association. The option to donate will be listed on the registration page. On February 26th from 2 to 4 p.m., join us as we celebrate the rich legacy of the Harlem Renaissance through performance and presentations that will be featured during our event, Tribute to the Arts, the Encore, a modern Harlem Renaissance experience. Throughout the month, check out our heart healthy recipes and infographics, as well as our Black artists and author spotlights in honor of Black History Month. Further information on these and all of our events can be found by following us on our social media sites and website, www.aka-upsilon-epsilon-omega.org. Again, thank you for joining us, and have a safe and wonderful evening.
Thanks so much for joining us this evening. If you would like to stay in the know with all that UEO is doing in the community, please visit our website at www.aka-upsilon-epsilon-omega.org. You can also find UEO on Facebook, Instagram, YouTube, and Twitter, all at aka_UEO. Thank you again and have a great night.